Again, thanks for joining us today, and I hope you all are doing well, keeping this COVID things at bay. I'll take a couple of minutes to before we start actual discussion on the ESOPs to give you a context how we reached to this point and what we are trying to do actually. So as you know, like DSCI engages with a lot of startups in cybersecurity data protection domain. What we have learned is there are certain areas which is aligned with say legal things or compliance related aspects where we need to have some insights coming to our founders, entrepreneurs, and the startups so that they can deal with those things in a more effective and efficient way, right? So with that intent, we identified a couple of areas. For example, something around say corporate governance, then merger acquisition. While you are going ahead for some merger acquisition related things, then what kind of compliance or legal aspects you have to deal with. Then comes to say fundraise when you are doing raising some funds, which is a very common thing. So what all you need to look at it, right? From the compliance and the legal perspective, broadly speaking. Now here the other thing that comes is the employee stock option plan, which we commonly known as ESOP, right? So these are 4 or 5 areas that we have identified. And definitely it's important to have the experts in that domain who can talk about it. So while we were talking to KLA Legal Associate, we are really grateful that they have agreed to join and with us to run this show. And from KLA Legal Associate, we have Mr. Shruti Dwivedi Sodi and Ms. Aditi. They are joining us today for this workshop. We have recently concluded one workshop around, say, fundraising conundrum, just to understand what all we need to do on that front, right? So on the similar line, we are doing today around ESOPs. And what we'll do is we'll just drill down all the related aspects of that. So first of all, thanks to KLA Legal Associate, Ms. Shruti, Ms. Aditi for this. And just add on is we'll do further similar sort of exercise going forward, right? Now coming to today's topic, it's like this ESOPs. In the startup world, we have been dealing with this term, we have been doing this stuff, but now in current scenario, I just take example what happened, say yesterday, there was a group of product companies. We were talking something around, say, talent acquisition, right? And from the startup's perspective or budding entrepreneur companies perspective, we see this ESOPs is something a very a key attraction point to actually onboard the talent, which is definitely a key for success of the organization, right? So broadly speaking, the ESOPs are definitely to attract the talent, giving away some sort of performance rewards or maybe some sort of futuristic plan for the employees so that they can commit themselves their time for to the company, to the start. We at that growing stage when we need that kind of providing that kind of response back to those people who are devoting that time, right? But when it comes to see ESOPs, it's not just giving away some sort of shares to them, some sort of equity to them. It's not that simple. There are so many things involved, so many legal compliance related aspects are involved in terms of issuance, in terms of kind of its grant, when it's getting vested and those kind of things, right? So today in our discussion, we'll hear from the experts, that is Ms. Aditi and Ms. Shruti, what all we need to look at when we are choosing that route of ESOPs. Then when we are talking about ESOPs, there are certain different ways comes in. So whether it's like typically what we have mentioned while we are reaching out to you all, it's like different routes of ESOPs, whether it's a direct route or trust route and related aspects to that. What all comes along if we are picking up one particular way to give away the ESOPs. Then different stages. When we are granting, what kind of things are there in terms of taxation, in terms of legal and compliance related things. When these ESOPs are getting vested, we call it like vesting stages of those ESOPs. What all that entail from the startup perspective as well as from the employee perspective who is getting it actually, right? So these are the broad level things that we are going to discuss today. And with this, I'm not that detailed expert of the topic. I'll request Ms. Aditi and Ms. Shruti to join on the stage and take it ahead from here.
Can you hear me, Alok?
No, I can see you and hear you as well.
Got it. No, thank you so much for this opportunity and this collaboration. It's always a pleasure collaborating with you and DSCI, and obviously Deepak keeps us honest on our calendar and schedule, and that he makes sure that we do give the time we've committed to. So thank you, Deepak, as well. And yeah, I mean, you know, it's you have picked up from a startup perspective 4 or 5 key areas that we need to kind of support. And specifically, I have a special place for technopreneurs, you know, technology entrepreneurs, because, you know, they're doing things that they're best at, which is creating new technology and innovating and creating new solutions. And therefore, you know, things about fundraise, stock options, governance is something that they would want some better, you know, perspective on, so that they can also then navigate. So clearly, I'm rooting for them for what they do, and, you know, of course, you know, looking at whatever we can contribute through this session today, even otherwise in case there be a need. So clearly, I mean, from the perspective that you rightly touched, you know, you gave a very helpful overview of what stock options are, and, you know, what could they be kind of considered from a perspective of any organization in its growth stage, both for value creation for the company, for themselves, and also people who commit their time to them in their journey as they go along. That those being the employees. So in that context, one of the key tools that has come up for people, for organizations and founders to utilize in the startup space specifically, is employee stock options. It is one tool which serves several purposes. It serves an employee's dream of wealth creation, given they commit to an organization. It serves the company's need for creating value for themselves and people that are associated with the company. And above all, it fulfills a founder's need of being able to attract and retain talent that it would otherwise not be able to afford. So it is largely to, you know, to kind of make all these things work, that employee stock options have become very popular in the startup space. How do they create wealth? Well, there you would, I'm sure a lot of you have heard about all the opportunities of buybacks, and all the opportunities of you know, new stocks being issued prior to listing, etc., like Atul mentioned, that gets offered to employees. So clearly, what's in it for the communities involved? A lot, and that's precisely what we are trying to go cover in our session today. So like you see, you know, there is Aditi has very helpfully put up the entire overview. Of course, there is the introduction, and we will get into a little bit of the nitty-gritties of what ESOPs are, who are they given to, how are they issued, and what do you need to do to get this entire structure in place. Given Aditi, like Atul mentioned, is my partner in crime, and is absolutely the expert who's been doing this day in and out for the startups that we as a firm work with and support along the journey. And of course, you know, she she is the person who holds the baton from a startup perspective. I will not only welcome her, but also acknowledge her for all the partnership that she's been providing, and then hand over the stage to her to take the show away and educate us on what we got on ESOPs. Over to you, Aditi.
Thank you so much. Thank you so much, Atul and DSCI, for giving us this opportunity of putting this collaborative 4 presentation sessions. Thank you, Shruti, for the lovely introduction. I will just deep dive into the topic, ESOPs, employee stock options. Essentially, ESOP in simple words is an employee benefit scheme. Given the increase of the number of startups in the country, it is one of the most important thing for a survival of a startup is to efficiently plan resources, basically getting the right assets, the right tools to put together a powerful team in place. There is aggressive competition in the market, so it becomes very challenging to acquire the right talent and to retain that right talent. One could solve this from rewarding the employee appropriately and ensuring that the contribution that they make in the company is rewarded and acknowledged, and that's how a company would be able to retain the employee. So one such mechanism for rewarding an employee is ESOPs. It definitely encourages employees as it helps them acquire shares in a company. It's been a shift from the earlier traditional channels of rewarding employees with cash. So ESOPs essentially come with a twin objective of hiring and retaining the best talent for a long period of time.
And if I may just add to what Aditi is saying, she's very helpfully said what are the 2 objectives. Why does an organization, even consider that from a value creation perspective? It is one of the key things that has to be kept in mind. And as we move along, Aditi will also throw more light on it, is that the twin objectives of rewarding and retaining have to be commensurate with the skill sets that you're using it for. So while it looks lucrative, it has to be expended judiciously and expected judiciously as well. So it's a twin thing as to how do you set expectations around it, and therefore the guardrails or the framework or the terms and conditions that you put around it have to be very strategically and specifically thought around. So, sorry, Aditi, I just thought I'll add that to your objectives.
Sure. So like we were discussing, why ESOPs, what are the benefits of ESOPs for startups? So it is beneficial from an employee standpoint and as well as beneficial from a company standpoint. So if we look from a company point of view, what happens is that the company is able to identify and acquire the right talent for the task and for the role that they're looking at. They're able to obviously control their cash outflow. There is not immediate cash compensation which needs to be paid in case the salary structure is put together with an ESOP input in it. They're able to retain talented employees. Also, if the company is growing, there is a direct relationship with the increase in the value of the company to the increase in value of what an employee takes home. So obviously it creates a sense of ownership in the employees, thereby establishing connect and having them to put their 100% to what they're doing. From an employee standpoint, what we could see is that obviously there's a sense of security because where you're working, you also you are a part owner, I would say. You own shares of the place you're working at. It obviously motivates the employees, and it gives them the ability to put in their best and make the company reach and achieve its goals. So that's from an employee perspective.
Sure. No, so absolutely, it's about helping startups conserve cash where it's needed, and also while conserving cash, build equity for the company as well as the employees. Go ahead, Aditi.
Yeah. What are ESOPs? ESOP essentially is an option given to a director or an employee of a company. It could be a holding company, subsidiary company, and it's essentially an option and the benefit or the right to purchase shares of the company at a future date at a predetermined price. How it's an option, it is not an obligation. It's essentially a right to purchase shares at a future date. Essentially, ESOPs are also linked to certain terms and conditions. It could depend on certain achieving of certain milestones, spending a period of time in the company. So it could be a mix of both, wherein there is a time period as well as some sort of performance linked milestones to achieving ESOPs.
The fundamental thing here is option, that it is an option. Why is it different from all other pieces? It's not equity shares. It is not any other aspect of, creating a stake within the company. It is an option that exists both with the employee to exercise it on the basis of the terms and conditions that are attached to it. And if those terms and conditions are not met, it is the option of the company to retract that option. So therefore the fundamental, it's been devised as a tool that it can be used both ways if the overall objective and the terms and conditions around it are not met.
Right. So now we should understand who is an employee. An employee essentially means a permanent employee of the company who has been working in India or outside India. It also includes a director, even a full-time director, but it does not include an independent director. Now, this permanent employee or director can be an employee or director of a subsidiary in India or outside, or of a holding company or an associate company. For example, if there is a company X and it can have an ESOP plan for its subsidiaries employee. So that would get covered within the definition of employee. Now, what is not included in an employee? So the critical aspect is that an employee who's a promoter or belongs to the promoter group does not qualify as an employee. A director who either himself or through his relative or maybe through a body corporate directly or indirectly holds 10% in the equity shares of the company, that director will not be included within the definition of employee. Now, interestingly, a DPIIT registered startup can issue ESOPs to its promoter or a director holding 10% equity shares in the company up to 10 years from the date of incorporation or registration. So there is an exemption and a relaxation essentially for startups which are registered with DPIIT.
Yeah, so essentially, technically, all these, DPIIT is doing a great job out there of, creating value additional benefits for its, for startups that are registered with it. And, one of those key ones is the fact that, the entire promoter group or director group that doesn't qualify otherwise for ESOPs can now look at getting the ESOPs in the space. While the employee definition is very, very wide, it does need to have its exclusions, which is why the original definition has those. So essentially, from the perspective of startups, there is this liberty available. We had a little guest also on our session. This is something that needs to be kept in mind. I don't think a lot of organizations and startups know that there are specific benefits that are available with the registration. And therefore, this one actually is a key one. So I did want to just emphasize as Aditi was talking about it. Thanks, Aditi, for this one.
So Aditi, just a small question here. So for this DPIIT registered startups, so within that 10 years of time frame, if they take exit, right? So then all the normal norms will be applicable on those things, correct?
Yeah, so all clauses will be applicable. This is just a small relaxation, basically for like a promoter. So basically a promoter of a startup and that startup being registered with DPIIT can get ESOPs.
And that will continue even after 10 years, right? If that company is running.
Yeah, if you've gotten the ESOPs, yes, those remain with you, unless you've not fulfilled certain terms and conditions by which either they fall away or expire or whatever else.
Okay, got it. So, thanks.
Okay, so all of us have heard these words a lot of times: grant, vest, and exercise.
Yes, I will definitely like to learn it a little differently this time, Aditi, because every time you listen to them, you hear a new thing.
Right. So an ESOP is obviously a three-step mechanism, which entails these three steps, which is grant, and then vesting, and then exercise of the ESOP. So we'll take the first one, which is the first step, which is grant, which is when an employee or a director receives the right. So granting essentially means an option which can eventually be exercised in order to get shares in the company. It is purely an option to avail benefits under the scheme. At this stage, no share is granted to the employee. It is just an option. And the options are not under law, under the corporate law. Options are not transferable. They cannot be pledged, hypothecated, mortgaged, encumbered, or alienated in any manner. So they are just in the form of options and not shares. The second step is the stage of vesting. Essentially, once the grant happens, then there is vesting. Vesting is when the employee becomes eligible to convert his option into shares. In many situations, we've seen that many companies have a proper vesting schedule. This schedule could be linked to the number of years the employee has spent in the company. At times, it can be linked to certain performance conditions, or it could be a blend of both term as well as performance. The company can freely decide the requirements of vesting and the period of vesting, and also the maximum period within which the option shall be vested. However, under law, there has to be a minimum period of 1 year between grant and vest. So there has to be 1 year between granting and vesting. So say, for example, if options have been granted on, say, 16th of February 2022, then the options can only vest on 15th February 2023 and not before. So that's vesting. The third is the exercise. If an employee decides to convert his options into shares, it is called the exercising of the option, essentially exercising the right. The employees does not, till the time the employee does not exercise its option and gets shares, the employee does not have the right to receive any dividend or to vote or in any manner enjoy the benefits of a shareholder in respect of the option granted to them. This is
at the time of exercise, they technically become a shareholder because they've exercised their right and gotten a share issued against that option.
Right. So essentially, yes, once the employee exercises the vested options, he would be allotted shares by the company, and that's when he will get the right, the shareholder rights that belong to that shareholder of that company. The company also has the freedom to specify a lock-in period for the shares issued pursuant to the options, pursuant to the exercise of options. So these are the three stages, which is grant, vesting, and exercising.
Aditi, I had a question. Essentially, when do these stages get differently treated? Essentially, we are talking about employees here. And it's also about, a lot happens within the journey. Like I know between, clearly if the law prescribes 1 year between the grant and the vesting period, then obviously that 1 year has to be complied with. But keeping that aside, any occasions, what happens, in certain circumstances, say for example, and I'm just thinking of two on the top of my head, maybe, if I decide to move on, I'm an employee, I decide to move on from the company. I did have the stock options, some of which were grants only, some of them had been vested, and so how does that get treated? And God forbid, I mean, we are all living in a very uncertain world, COVID, included. If something happens to me, if I'm unable to work beyond a period of time, or if something happens to me, permanently, so supposing if I die, so sorry, I'm painting very grim pictures for you out here, but it will be helpful if you could help me understand a few of those.
Right. Very rightly pointed out, Shruti. Yes, the law does cover for such situations. In case, like we'll begin with, if the death of an employee while in employment, all the options granted to him till such date shall vest in the legal heir or the nominees of the deceased employee. So that's a situation when all the options granted to him get vested in the legal heir. We could also take a situation of an employee when an employee suffers, any sort of permanent incapacity while in employment. All the options granted to him as on that date vest in him on the date of the permanent incapacitation. So these are the two situations. The third situation which you discussed about was in case of resignation or termination of employment. All options not vested in the employee, as on that day, they lapse. All the options lapse. The options which have been granted and vested, there is a particular time period given to the employee to exercise those options which are vested in him. We generally see a 3 to 6 month period for that companies allow for employees to exercise their options.
And this would be largely to keep the cap table, in a particular format and clean enough for it to be that way. So there will need to be an exit option. If you are exiting, you will need to exercise those options.
Absolutely.
I think I see a question on the chat, Aditi, from CK. He wants you to explain grant and vest a little again. So if you can just speak about grant and then vest, it will help CK understand.
Right. So essentially, grant is when an employee is granted an option. Essentially, it's an option, not a share. No shares are granted at that stage. It's essentially the right it's a right to the option, which the person receives on that particular day. There needs to be a 1 year period between granting and vesting. The shares may vest, say there could be a vesting schedule wherein, say, on day one, someone is granted after completing 1 year of employment, they are granted 10 options, and those 10 options will only get vested after a period of 1 year from the date of grant. Once they are vested in the employee has the right to exercise that vested option. And when it exercises the vested option, they can get a share in the company.
That's an interesting question, Aditi, for you. Sanjay is asking, and why I'm reading that question out to you, because it will help everybody understand. This is a very critical piece that we need to explain and have everybody understand that. So Sanjay wants to know if I've gotten that,
Can we request everyone to keep it on mute? Can we put everyone on mute from that?
Maybe Deepak can mute.
I guess.
So, Aditi, are you there?
Yeah.
Okay. Sorry, you were not showing up on my screen. So Sanjay wants to know if the shares got invested to me, why will I not exercise it right after 1 year?
Right. So
maybe you'll come to it a little later, but you could give a flavor to that question. It's a very interesting one.
Right. So there is also once there's a minimum grant period, the vesting, there could be the board and the way the policy is, the ESOP policy is drafted, they could have certain period, like say for example, they could say that the options which have been granted to the employees will vest say on a 6-month basis, 12-month basis, like a yearly basis. And once the options are vested, the employee may want to exercise it at a later stage, given that the employee would have to pay an exercise price, and obviously there will be some sort of taxation, and would want to exercise it at a later stage when the company is achieved a particular milestone and would want to exercise it at that point in time.
Also, exercising it makes you a shareholder, and it also has a certain tax considerations that kick in. So therefore, while it may have vested with you, you may want to keep it on hold till you do want to get to the stage of exercise. I'm sure Aditi is covering that piece, later on in the conversation. Also, I think there is a question as to what is the period between vest and exercise. There is no limitation and no period that you need to have between vesting and exercise. Great, Aditi, we'll keep taking the questions. I don't want to curb your flow. We can move on.
Moving on, the essentials of an ESOP, like we discussed, the grant, vesting, and exercise. Typically, when one needs to draft an ESOP scheme, that is essentially the umbrella document that governs ESOPs. The most important part of an ESOP scheme is to clearly set out the purpose and intent of rolling out the plan. This is the only document which gives the employee also the idea, the purpose of issuing ESOPs. And there are other few important clauses such as what is a grant, what is vesting, is there a vesting schedule, what will be the excess, when would one be allowed to exercise its options. Typically, some ESOP plans may have also the exercise price, but we have mostly seen that essentially people put that in the letter of grant of the employee, so it becomes very easy to amend, because amending the ESOP policy will have its own set of challenges, as in a proper board meeting would need to be conducted, a shareholder meeting would need to be conducted. So keeping these specifics around the vesting schedule as well as the exercise price, we have seen that getting covered in the letter of grant, or in the letter of grant and the exercise letter essentially. So the first one being the drafting of an ESOP scheme, calling a board meeting and shareholders meeting to approve the scheme, issuing the letter of grant to eligible employees, vesting of options, followed by the exercise by the employee issuing a letter of exercise to the company, thereby exercising its options, and followed by the company allotting shares to the employee. Certain necessary, secretarial filings are also required to be undertaken during this process. Obviously, this process may also be different in case of the different routes that we adopt. This could be a proper direct route mechanism. There could also be a trust route, which we will be discussing at a later stage. So primarily, this is how an ESOP process would look like from a direct perspective.
Yeah, and just to add, and the time or the terms between vesting to exercise can differ from ESOP policy and scheme, like Aditi mentioned, to scheme. It clearly, this is a private look at it. It is a private document that is being designed by one company. As long as it conforms to the basic parameters of law, it can have any terms and conditions that the board and the strategic members of the team who are drafting and driving the ESOP policy think will be best suited for meeting the company's objectives and will also adequately remunerate and incentivize the employees. So clearly, a lot depends on who are the people drafting and creating the scheme to be able to, decide what are the larger framework of this exercise. Yeah.
Yeah. So we will move on to the purpose of ESOPs. Essentially, there is a direct route concept.
I just wanted to pause here for 1 second. I know there are a lot of questions coming in. One way, I'm trying to pick up the ones that kind of work with the slide. If there are questions which are beyond the slide, I'm requesting that we will answer all those questions, but we'll perhaps take them at the end of the conversation so that we can then holistically answer those for you, if that's all right. Sorry, Aditi, go ahead.
No problem. So essentially, from a startup and a private company perspective, we see most of these companies go for the direct route, given that because of ease of administration. In the direct route, the company grants the option, and at the time of exercise, fresh equity issuance is undertaken, and on exercising, the employee also becomes the shareholder of the company. The option obviously to exercise the ESOP and get equity shares in the company, as in the option is when it has an option, it is not transferable, and no shareholder rights are available until the employee holds shares in the company. Only after the ESOP is exercised, they get dividend and the voting rights in the company. And there could be a situation where the private company has the freedom to determine the lock-in period also for these shares. So direct route is most preferred and cost-friendly in terms of startups and private companies. Moving to the trust structure, the company needs to create a trust specifically for the purposes of administrating the ESOP policy. The trust that would be set up under the Indian Trust Act would need to be registered with a sub-registrar, where the employees decide to exercise the option to acquire shares. The trust would first acquire it either through a primary issuance or through a secondary sale. And once the shares have been acquired by the trust would transfer it in the name of the employees. So that is typically direct route and the trust route structure.
And trust route is essentially not opted for by startups or younger organizations, I would say. Is basically it's clearly just a cost and management issue, because there will be extra manpower required to kind of manage the trust as an entity and body and structure. As also there is costs involved in creating a trust, administering and managing a trust. So clearly perhaps that's one key reason that younger organizations go for the direct route.
Yes, I think I saw a couple of questions. Do we want to take any questions on this one? I think
sure. You, the boss, you take whichever questions you want to take right now.
Yes, I think someone was asking what is the benefit of having a trust route. So I understand obviously it comes with a cost, but certain benefits of undergoing the trust route is that no fresh allotment is required in certain cases. Essentially, the promoter may transfer, or any sort of secondary shareholder may transfer. There could be an arrangement and they could transfer the shares to the trust. Then there would be no need of doing a primary issuance, which would probably lead to a dilution of the cap table. So that way, from a trust, there is a flexibility of doing a primary or a secondary. The second thing from a trust perspective could be that so the Companies Act also recognizes this trust structure, and obviously under the Companies Act there is there is a provision wherein the trust, the company can give a loan to the trust to purchase these shares for the benefit of employees only. So it is a recognized concept, and when in case if a employee is leaving and the company is unable to do a buyback, the trust could essentially buy the shares from the employee itself. So that's from a trust route perspective.
There was one also on exercise price, Aditi, which was on a slide previous. Maybe we can just answer that as well. What is the the right to employees? Do we grant the right to employees at a certain price to vest when the minimum 1 year period is over? Also, can the pricing differ once the vesting period gets due when the employee can exercise the right? So
the exercise price needs to be determined at the time of issuance of the ESOP. So it is very critical to be determined. Probably you can have it put in the letter of grant, wherein there will be other terms of grant, terms of vesting, and the terms of exercise, which would include the exercise price also. The company has the freedom to determine the exercise price subject to compliance with certain applicable accounting policies. So
so essentially, as long as you followed the accounting standards, the reason how ESOPs are beneficial is because there is a predetermined exercise price, which is at a discount to the not only to the market value at that time, but also obviously gives you the opportunity to make incremental benefits at the at whatever time you exercise against the valuation at that time. So clearly the gap between your exercise price and the valuation whenever you're exercising becomes your notional gain at that time till you decide to then take the next step of selling it off and making that entire money monetary gain. So it's not cash till you make it cash. Yep. Should we be moving on?
Yep.
Yes. This is answering in detail the previous question, Aditi. Go ahead.
Right. So yes, apart from companies law, obviously listed companies have their set of SEBI regulations that need to be followed from an ESOP perspective. There are also regulations from a FEMA standpoint, and as well as taxation, tax laws. We will dwell upon how an ESOP is essentially taxed. ESOPs, like we discussed previously.
Aditi, just sorry to pause you here. As we speak about tax, I will also be keen to request you to see how do we take care of the other law. So companies law is there. You're obviously touching upon taxation. I would also be keen to know how would any cross-border scenarios, what laws and how would those get answered. Sorry, you were talking about tax. I just remembered that will also be a useful thing to address in this slide.
So we can pick up taxation, and then we can look at the FEMA angle also.
Yes, thanks.
So like we have previously discussed, that ESOPs have 3 stages, which is granting, vesting, exercise. And then eventually once a person becomes a shareholder, the employee becomes a shareholder of the company, he also has the right to sell those shares. So at the time of grant, only a grant of an option is made to the employee. So therefore there is no taxation, no tax involved at the time of grant. The second is at the time of vesting. Given that the options vest in the employee, there is no tax that is required to be paid by the company or the employee. Now the third stage, which is the exercise stage, this is an important stage. Here tax is payable by the company and the employee. First levy occurs when shares are allotted to the employee after he has exercised his option on completion of the vesting period. At the time of allotment of shares, on the exercise date, the difference between the fair value of the shares and the exercise price is something which needs to be taxed and is looked at as a perquisite. So, for example, if the exercise price is 10 to get the option converted into a share, and the fair market value of the shares of that company is rupees 100, then obviously there is a 90 rupee difference, which is treated as a perquisite and forms part of the salary of an employee, and the employee needs to pay taxes on it. The company, on the other hand, given its
TDS gets deducted on that.
The TDS gets deducted on that amount. So that's at the time of exercise. Now there is a situation that once the exercise is happened, the employee becomes a shareholder. The employee would further sell it. The employee may further sell it to a third party. In case at the time of selling to a third party, the cost price would be treated as 100, and the price at which the company, at which the employee sells the share, that would be the sale price, and the difference would be taxed as capital gains. So capital gain occurs when the employee opts to sell the allotted shares under the ESOP. So in case the employee sells at rupees 200, the differential would be taxed as capital gain, which is 200 minus 100, and the 100 would be the differential on which tax would be paid.
Yeah, I think we can answer Kiran's question here. It's very interesting and it's right on point for this slide. That, you know, if at exercise stage I'm just purchasing the share, why is there a tax? So, you know, tax, Kiran, at that stage is on a notional value, but because there has been a gain, you have bought something for, or you've been granted something at rupees 10, the value of which is 100. Therefore, right now, the minute you exercise, you are owner of a 100 value item or a share. And therefore, you have gained those 90 rupees as part of your perquisite. Perquisite is a defined term under the income tax laws, and there needs to be a tax deducted. Like your salary comes after deduction of tax, a perquisite, which is a part of your salary, needs to be paid to you only after deducting tax on that. Therefore, there is a tax at the stage of, when you purchase or exercise your rights. Interestingly, there was a very, very key request made by a lot of angel networks and angel fund community before this budget session to consider from a startup perspective to not tax it at the time of exercise. But there hasn't been much headway made yet on that. That's an interesting space. You have a valid question. It is a valid request by the startup community already made right up till the finance minister. But yeah, it still exists as is. We'll keep watching the space and let you know if that alters in any way.
So I think there's one thing that I needed to clarify. I don't know if it was brought out appropriately. So when we tax that perquisite, the difference is between the fair market value, the exercise price, and the fair market value of the company as on the date of exercise. So the employee has already paid tax on that 100 minus 10, 90 rupees. So when the employee sells it to a third party, the cost price for the employee will be 100 rupees, and it will not be 10 rupees, because the value created from 10 to 100, tax has already been paid on that. Right.
Also,
I answered Kiran's question.
Yeah, and also, I know these are very interesting, valid questions, and they, we are trying every bit to kind of answer them as we move along. But if there are any that still remain, Alok and Deepak, I'm taking the liberty of saying that they can write into you, and you can pass them on to us, or they can, write in, whichever way you consider appropriate. Because the intent is that we do everything we can to answer all those queries and very, very valid questions.
For sure, Shruti, actually, and it's really sort of clearly visible, like the interest of the startup community in this ESOP as a topic, right? So many questions. Rarely we get these kind of these number of questions in like 1 hour session, right? So I think every point has one or other question. And thanks to Aditi and you for clarifying all these questions actually so far. Definitely to all the participants, we'll request if you can send the mails to us, and we'll collate, go back to the experts as they are here, and come back to you with the solutions.
Right. So moving on, we also wanted to touch upon the FEMA aspect. So essentially, there could be a situation wherein Indian companies grant ESOPs to persons resident outside India. I mean, under FEMA, ESOPs take the same definition as of the Companies Act. ESOPs can be issued to employees, directors, like under. Basically, under FEMA also, compliances under the Companies Act need to be followed. So that is point number one. The second being that the ESOPs need to be in compliance with the sectoral caps. So if in a particular company there is any sectoral cap, and if that sectoral cap is breached, prior government approval will need to be taken. Third, if there is a company, if there's a company which is in the space of, in an FDI space where government approval is required for foreign investment, then for issuance of ESOPs also, the requirement of taking a government approval will kick in. Interestingly, there could also be a situation. So, for example, at the time of grant, the employee is a resident Indian. And at the time of exercise, exercising of options, the employee becomes a non-resident. In that situation, such shares will need to be held on a non-repat basis. And because that the conversion of, because at the time when he had been granted the option, he was a resident, and therefore this ESOP issuance will be on non-repat basis. There are certain filings which need to be made at the time of issuance of an ESOP. The company needs to file form ESOP within 30 days of the issuance of the ESOP, and at the time of issuance of shares, the FCGPR requirement kicks in. And that needs to be filed on the firm's portal. So that's from a FDI perspective, FDI ESOP perspective. Now, I would also like to cover from an ODI perspective. Essentially, foreign companies may issue ESOPs to Indian residents, and basically any foreign company which has an Indian branch or an Indian office or a subsidiary in India of a foreign company can grant ESOPs to an Indian residents. However, there are certain requirements, which is essentially the rules that need to be followed are that the shares under this ESOP scheme granted by the foreign company are offered by the issuing company on a global and a uniform basis. So basically, if they are rolling it out for Indian residents, they should roll out similar on similar terms and conditions to other jurisdictions as well. There will also be a requirement of an annual return that will need to be filed by the Indian company, informing, giving information about the number of ESOPs issued to the employee, the amount of remittance that has happened. So yes, from an ODI perspective, also Indian residents can hold ESOPs of foreign companies.
And the exercise of it, etc., will then again need to be, following the exchange control regulations.
Right. And there are also certain, filings that need to be undertaken, and the onus of filing would be on the entity Indian company. They need to file annual statement in form ESOP on a regular basis. And there are certain filings which need to be undertaken from an exchange control perspective.
Got it. That's helpful, because ultimately, a lot of these younger organizations are either expanding, internationally, or looking at, some kind of, arrangements which has, Indian and international.
develop over a period.
Great, Aditi. What's next? What have you got next for us?
Yes, so I think we're about time. I just quickly move on.
Oh, wow.
Last one, which is
This
the
is
way
homework
forward.
for us, is it?
Yeah, so essentially, get TPIIT registered is one of our key recommendations. Create an ESOP pool on your cap table. Having a well-drafted ESOP policy is very, very important. There is no one way of drafting it, obviously. It will depend on facts and circumstances at the stage at which the company is. Revamping the salary structure, having maybe a limited cash component as well as an ESOP component, and alignment with investors is also very, very important from an ESOP perspective.
I'll just lean a little on Aditi's first recommendation, which is the DPIIT registration. Mind you, if you're a startup and you're not registered as in the DPIIT, and if you are a founder of the startup or a director holding more than 10% equity, you will not be able to avail the benefits that are accorded to startups that are registered with DPIIT. You would be treated as any other organization and will not be able to take those benefits. So the recommendation is only so that you can get or you can avail of what you can rightfully do. So that's why the recommendation. Great, Aditi. Do we have time for questions? Hello, Deepak. Atul and Deepak. Or is it time? We'll look at you as to see how you want that to be addressed.
If we have a couple of questions, one or two, we can take. Else, definitely, Deepak has shared his email ID actually, so we'll get more questions. I'm expecting a lot of questions coming in for this actually.
No worries, they're always welcome. They help us learn as well. The questions help us think and learn a little more. I think there's one question on value creation, Aditi, which we, essentially we can answer that with all the recent buybacks that are happening. What's that question? I'm trying to scroll through the screen and see. Can you spot it, Aditi?
Yeah, I'm just clicking on the top.
It is being observed that provides the ESOP to the employees. Let's say now employee wants to liquidate the ESOP or wants to return to the company, what options he or she has. Will ESOP is to be traded or brought back at premium price to be highlighted legally. So maybe we can touch upon the buybacks that are happening and the value creation that startups are doing for their employees through these.
Right. So recently, we've seen this Bangalore-based tech company which has announced its first buyback, and there is obviously the ESOP buyback is a process where the company seeks to purchase the shares that were granted to its former or current employees via the ESOP scheme, while the employees get ESOPs at their fair face value, which is ideally between. It could be ranging depending on the exercise price that has been put in. There has been a lot of value creation in this space by startups undertaking buyback and creating wealth for more than. The figures are way too high, and the buybacks are now a common feature in the space.
So essentially, to your question, buybacks are the ways of you wanting to liquidate your ESOP, and companies when they don't want to kind of dilute the equity further and also want to incentivize you for whatever you've done. Buybacks are becoming extremely popular and are being actively utilized by startups to be able to keep the option of retaining that equity within the company, as also incentivizing the employees. Over to you, Atul. I know we are 5 minutes beyond time already.
Yeah, I think Varun has one question. He was raising hand. Varun, if you have any, just put it here. We can quickly take. Else you can.
I put it. So I'll also call it out for everyone's convenience. First of all, thank you for the wonderful session. So my question is, what is the ballpark? How do you decide on how many shares to be given in ESOP? I mean, is there a calculation like equal to the CTC? What is the standard way of deciding?
There's no particular standard way of doing this. We have seen a range of 0 to 15% being allocated to the ESOP pool on a cap table. Now, it would depend on the kind of talent that you're bringing on board, essentially depending the experience, and it has to be a mix of both a CTC and an ESOP compensation. We have also seen only compensation in the form of ESOPs and no cash compensation, because at the early stages of a startup, it's difficult to generate that amount of money to get to hire talent at senior levels. So it will totally depend on the stage at which the startup is, the kind of talent that we are wanting to onboard, and third, the liquidity, the working capital of the company.
Okay, I got that answered the question partly, but the actual question is like, if you're giving someone salary worth CTC worth 5 lakhs a year, so is there a ballpark or an accepted practice that the ESOPs will be equal? You give shares equal to those 5 lakhs CTC, or a 1x, 2x, half x? Is there anything like that?
Shruti, I think you are on mute.
Sorry, I was speaking. So I got that question from you, Varun. Essentially, no, that is not the, that may not be a fair comparison or a rationale for this. ESOP scheme, see, ESOP is not commensurate to one individual employee and their salary, or commensurate to that, or in proportion to that. ESOP scheme is a universal scheme for either the entire organization and set of employees. A lot of organizations are doing that, or for a particular category or band of employees. So for example, usually it is used for, you're right, there could be a salary threshold and above for a category of employees which are largely strategic and critical to the organization, who it is very important and essential to retain as talent within the company, and who are bringing in a lot of value add to the company. So there is a general group of people and an allocated pool, like Aditi mentioned, of the share, cap table that is kept aside. How is it used is discretionary and basis certain terms and conditions, who's bringing in what value, and therefore X percentage from the ESOP pool or X, will be allocated to this person, say for example, Varun, for the value that he's bringing to the organization. So it is not in any way related to what your CTC is. It is related to the scheme, the value add, and the management decision of how much should come to you for what you bring to the table.
Okay, thank you. So it's basically percentage of the ESOP pool. It's not percentage
Yes.
of the company. It's percentage of the ESOP. Okay.
Yes.
Right.
And usually a company keeps anything between 0 to 15% on the cap table, or it may create the pools in different stages and tranches, but no company has more than 15% of its cap table as an ESOP.
So you can start at 5%, and as the company grows, you can take it to 10%, 15%.
Yeah.
Exactly. You're right. Absolutely.
And the 5% also increases when you're when your authorized share capital increases, automatically that 5% number of shares in that 5% also increases. Thanks. That was helpful.
Okay, thanks, Varun. So I think awesome session. I would say definitely a lot of questions, all answered so far, and we'll get.
Thank God for that.
Yeah. And actually, definitely, we are going to have more and more questions. Now, we don't have time left, otherwise, definitely. One request that upfront we got is for another session after this wonderful session, definitely. This is stock appreciation rights. This is also one area of interest for the startups. Probably we can separately discuss and find out ways to address that as well. So again, thanks a lot, Shruti and Aditi. It was really wonderful session. I think we are getting lot of remarks here. So it's everybody got a lot of things insights around this topic. And for the participants, we are again going to have similar sessions. One is definitely on the corporate governance, and similar sort of other sessions will also host. We'll keep you posted on that. Looking forward to have you in our future sessions. So thanks a lot. And again, thanks Shruti and Aditi.
Thank you, Atul.
Always
Thank you.
Ketan Legal overall team for joining hands with us.
Thank you. Thank you.
Thank
Bye.
you so much. Thank you so much, everyone, for joining.
Bye-bye.
Thank you all.
Thank you, everyone.